Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Okay, so over here, these were the absolute highs made back in December in the euro. All right, and you won't be able to say. I mean, we were bearish here, but there's no way we're going to say the euro is going to collapse from those levels. But this is what I'm talking about with confidence. So with something like this, Stephen, let's say we are confident we have a shooting star confirming resistance. Our stop is over here. So let's say our stop is, let's say, 150, 150, and our target, we have no way of knowing, it's going to break under the target. Let's say our target is 148. So what kind of trade? Would you just do an outright, and let's say we're predicting it's going to happen over 3 or 4 days. Would you just do a put on that, or because it's kind of limited on the downside, you do a bearish spread?
Yeah, either or. That's a great point. You might buy a put. You could sell a credit call spread, depending on how what your risk tolerances are.
Okay, so let's say our risk is 150, 150, and this is our target. Okay, so what kind of thought process do you go saying, okay?
So more than likely, I'm thinking about doing a put spread. I'm going to buy a put spread and try to capture most of that move there by buying the 152, selling maybe the 148 put. So that's a $4 with. Maybe you're buying it for $1.50 or something like that, maybe $2. So the risk reward is roughly even. Obviously, in this case, it would have been a great trade, an absolute perfect trade. The biggest problem with that trade, Steve, and I know you're going to touch on in a moment, is that you were so right. You're actually unhappy that you sold that other put.
Right, and that's the question. Right, I'm going to get to that. But what makes you do a spread instead of an outright put at this selling it here? Is this because it's a limited target?
Right, and because maybe, and I'm going to draw up, maybe instead of it breaking, you thought the market might actually continue to just not go down but not go up, and it's going to be neutral. The put spread, you probably wouldn't lose any money if it stays neutral. If you buy the put, more than likely you're going to lose money. So this is added insurance if the market stays neutral.
Right, okay, yeah, because obviously with a put, you have, if you go outright put or call, you have time value working against you. And
exactly.
That's one way to, great, okay. Now let's, and you mentioned this, Stephen, so let's say we're over here, and let's say we're in the spread, and maybe we'll take some profits here, but there's no really bullish candlestick signals. We don't have a hammer. So we want to, the market breaks support. All right, so we're in the spread now. So what would we do? Just leg out of one side of the spread and let it ride?
What you might do is you realize that, boy, the move's much bigger than you thought. You might actually buy back your short put spread somewhere in here. Because then you're saying, okay, well, I sold this put. It's actually up a little bit in value, but the one that I bought is up a lot. Right. And I think it might actually break the 146 or 145.
Right.
Well, why limit yourself? You try to buy back the put that you sold and try to gain a bigger profit by just having that single leg put on. Now, the risk is, of course, that it rallies back, but you're thinking that more than likely it's going to keep breaking down to these levels. You just basically want to be long a put, and you don't even want the put spread, so you would cover your short put. Does that make sense, Steve?
Yeah, and one of the things, again, there's so many topics a little bit we don't have time to get into, but one of my favorite Western signals is what I call change of polarity, where old support becomes resistance. So, we could take some profits here, I guess, on the spread. So we're locking in. We have, we take some profits in, so we have less risk less capital at risk. Then we can let the put ride, and if the market then closes above, I'd say 148.50, I'd want to be out of my long puts, and that indeed would have worked out well because old support became resistance. So, yep, great. Okay. Now, Josh is asking about a percent likelihood of a candle function working, and you should never use candles in isolation. All right. Don't trade on the information I'm giving you here. We're focusing only on candles. I'll talk about some resources later on that discusses, how to make candles as part of a trading system. But you could have a hammer. For example, you could have a shooting star. In one instance, I would recommend exiting longs, where you could have another shooting star like here, confirming resistance. I'd recommend going short. Other instances, there's a shooting star. I'd recommend doing nothing. So you could have the exact same candlestick signal, but where it is within the context of the overall technical picture, where it is within the risk-reward parameters. Sometimes you sometimes you do a trade with a candle signal, and sometimes you don't. Buying and selling in every candlestick signal is very, very dangerous. So the answer to that, Josh, is there's really no way to gauge using a candlestick in isolation to say, okay, your shooting star is 50% effective, because you should never use candles by themselves. So let's move on. Okay, now here we have a bullish engulfing pattern, white real body wrapping around the black real body. Once again, you don't have to be a real guru to understand what's happening here. The white real body wrapping around the black real body. Who's taking over from whom? It's always bad with that with English. Who is taking over from who, or whom, or whom, whatever it is. But anyway, the bulls are taking over from the bears. All right, it's a potential bottom reversal signal, and with that in mind, okay, here we have two bullish engulfing patterns, and I trade with these very, very differently. Here, I'd probably use this to cover shorts because based on what I have here, it's not confirming support, whereas this bullish engulfing pattern, notice how it's confirming the support area over here. So, again, turning it over to Steve, let's say we wait for the close because it's not an official bullish engulfing pattern until it closes. So let's say the market closes at 120, and our risk is down to let's round it off to 117, so risking, 300 pips, let's say, but our upside target, 119 to 117, about 200 pips, and our upside target is 124. So, we're looking a nice risk-reward. Would we do an outright call on that, or again, we would do a spread, a bull spread, or would we do a call? What's your thinking on that, Steve, and why?
I think it all depends. If you really think that it was going to have a major breakout, which I'm
very confident that this. I'm much more confident in this bullish engulfing pattern than I am on that one, because this bullish engulfing pattern is confirming support, and I'm very confident it's going to get to at least here.
So you might want to just buy the call outright, and then half to two-thirds the way through, you might want to sell a call, which, of course, if I take my pointer, might have been the wrong thing to do, because the market actually went further than we would have thought. But somewhere maybe through this candle, you buy your initial call, then you sell as a hedge. Not, of course, you don't know that the market's going to end up all the way up here. Right. You might sell a 124 call and buy a 119 or a 120 call, hoping, let's say it's a 120. You buy the 120, sell the 124 in a market rally. And in this case, you probably earn almost the whole width of that spread, because the market runs all the way past your initial expectation, runs up to whatever that is, 127, 128. You bought the 120, 124, and it's a great trade. The reason you always think about hedging, and this is what I do anyway, is that it helps you stay in the trade rather than if you have one day when the market turns back a bit, you're really concerned. In fact, you're thinking of taking a profit. The spread helps you have more confidence because you've hedged yourself a bit. And that's why I like spread trading.
Great. Okay.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.